Welcome to Agribusiness Finance, where we explore financial management in farming. This unit focuses on managing financial resources effectively for a sustainable agribusiness operation. Now let's discuss why agricultural finance truly matters for every farming operation. It serves as the essential pillars supporting both growth and stability in agribusiness. First, agricultural finance facilitates production by providing necessary funding. It ensures funds are available for seeds, fertilizers, machinery, and labor costs. Second, it promotes innovation within the agricultural sector. This enables investment in new technologies like precision farming and automation. Third, agricultural finance helps manage various risks farmers face. It provides tools like crop insurance against weather and market volatility risks. Let's explore the diverse sources of agricultural funding available to farmers. These are the various places where agribusinesses can find their needed capital. Commercial banks are one common source of agricultural funding. They provide loans for various needs, though they often require collateral. Government programs offer another important funding source. These include subsidies, grants, and low-interest loans to support farmers. Microfinance institutions serve specific segments of the farming community. They provide small loans specifically for low-income or marginalized farmers. Agricultural development banks specialize in farm financing. They offer specialized loans with particularly favorable terms for farmers. Trade credit represents another flexible funding option. This means getting goods or services on credit, paid later after harvest. Venture capital supports innovative agricultural businesses. It provides equity investment for scaling up innovative agribusiness ventures. Now let's examine how we categorize different agricultural loans. This involves matching finance to specific operational needs and timelines. Short-term loans address immediate financial requirements. These cover immediate working capital needs, like seeds and fertilizers, within 1 year. Medium-term loans support intermediate investments. These fund equipment or farm infrastructure over a 1 to 5 year period. Long-term loans are for major capital investments. These support large purchases like land or expansion over 5 years. Working capital loans maintain daily operations. They cover day-to-day operational expenses to ensure smooth cash flow. Investment loans fund significant capital expenditures. These provide funds for large purchases like machinery or infrastructure improvements. Let's explore the cornerstones of agribusiness financial planning. These are strategic steps for achieving sustainable growth and profitability. Budgeting forms the foundation of financial planning. It involves estimating income and expenses to manage funds effectively. Resource allocation directs financial resources strategically. This means directing funds to critical areas for maximum returns. Risk management protects against unexpected events. It involves building contingency reserves for unforeseen circumstances. Forecasting helps predict future financial outcomes. This uses data and trends to predict future financial performance. Profitability analysis evaluates financial performance. It identifies opportunities for income generation and cost reduction. Finally, let's understand core financial statements for agribusiness. These are essential tools for monitoring agribusiness financial health. The income statement, also called P&L, shows performance. It shows revenues, costs, and expenses over a specific period. The income statement determines overall profitability as net income. It's calculated as revenue minus cost of goods sold minus expenses. The balance sheet provides a financial snapshot. It shows assets, liabilities, and equity at a specific point in time. The balance sheet follows the equation: assets equal liabilities plus owner's equity. It helps assess the farm's overall financial stability. The cash flow statement tracks cash movement. It tracks cash inflows and outflows over a specific period. It covers operating, investing, and financing activities comprehensively. This statement evaluates the business's ability to generate cash. Now, let's explore the indispensable role that agricultural credit plays in modern farming operations. Agricultural credit is absolutely vital for farmers and agribusinesses to access necessary financial resources. Next, we'll look at how we categorize agricultural credit based on different needs and time frames. It's all about matching the right credit solutions to specific agricultural requirements and timelines. First, we have short-term credit designed for immediate operational needs. This covers working capital for seeds and labor, typically repaid within 1 year after harvest. Then, we have medium-term credit for more substantial investments. This funds machinery or infrastructure improvements, usually with 1 to 5 year repayment terms. Long-term credit serves major capital investments. This supports land purchases or large facilities, with repayment periods extending beyond 5 years. Finally, revolving credit offers flexible ongoing funding. This provides a flexible line for operational expenses, allowing repeated borrowing up to a set limit. Now, let's examine agri-insurance, looking at both its protection benefits and implementation hurdles. We need to carefully weigh the advantages against the common limitations farmers face. First, let's consider the benefits of agri-insurance for farmers. It effectively mitigates financial risks from natural disasters and market price volatility. Agri-insurance enhances financial stability and supports recovery after unexpected losses occur. It also improves access to credit, since lenders feel more secure with insured operations. Additionally, it promotes adoption of more sustainable farming practices over time. Now, let's look at the challenges in agri-insurance implementation. High premium costs can make insurance unaffordable for many small-scale farmers. There's often limited awareness and understanding of how these insurance products work. Many policies rely on accurate weather data, which isn't always available or reliable. Finally, claims processes can be complex and time-consuming for farmers to navigate. Let's explore the diverse agri-insurance solutions available for different agricultural risks. These are tailored protection options designed for specific farming challenges and needs. First, we have crop insurance, which protects against yield losses. This covers yield reduction due to natural calamities like droughts or floods. Crop insurance includes both yield-based and revenue-based coverage options. It typically covers floods, droughts, severe storms, and pest infestations. Next is livestock insurance for animal-based operations. This protects against death, disease, or injury of valuable farm animals. It's particularly crucial for dairy, poultry, and cattle farming operations. Weather index insurance uses objective data triggers. Payouts are triggered by specific weather data like rainfall levels or temperature extremes. This reduces the need for individual farm inspections and loss assessments. Finally, multi-peril crop insurance offers comprehensive coverage. This provides comprehensive coverage for various risks, including drought, pests, and floods. A single MPCI policy protects against multiple agricultural threats simultaneously. Now, let's examine essential financial ratios for agribusiness analysis and performance measurement. These ratios help us measure performance, liquidity, and operational efficiency effectively. First, the gross profit margin tells us about production efficiency. This measures how efficiently you produce goods relative to your total revenue. The net profit margin shows overall business profitability. This reveals your overall profitability after accounting for all business expenses. The current ratio assesses short-term financial health. This indicates your ability to meet short-term liabilities using current assets. The quick ratio provides a stricter liquidity measure. This measures liquidity without relying on inventory that might be hard to sell quickly. Inventory turnover ratio shows inventory management efficiency. This ratio reveals how efficiently you manage and turn over your inventory. Finally, asset turnover ratio measures asset utilization effectiveness. This shows how effectively you use your assets to generate revenue for the business. Let's summarize the key points we've covered in this section on agricultural finance. Here are the essential takeaways for effective agribusiness management and financial planning. First, agricultural finance is crucial for production, innovation, and risk management. Diverse sources and types of finance cater to varied agribusiness needs and stages. Financial planning, budgeting, and analysis are vital for long-term sustainability. Credit and lending enable necessary investment, growth, and effective risk mitigation. Agri-insurance provides a crucial safety net against unpredictable agricultural risks. Key financial statements and ratios offer valuable insights into financial health.